Picture a plastic dinosaur, a hypothetical one priced roughly the way many small toys actually are. Call it 80 cents to manufacture. It sells at the register for $20. Somewhere between those two numbers, most people assume, sits a very happy factory owner counting the difference. That difference is $19.20. And only a small slice of it, often the smallest slice of anyone in the chain, belongs to the factory. This is the strange arithmetic at the center of one of the most misunderstood businesses in the world. And it's worth saying up front that toy manufacturing is not one uniform business. A small plush workshop, a contract injection molder, and a vertically integrated toy conglomerate all run on different economics, and none of the figures in this story should be treated as a single template for all of them. But a shared pattern runs underneath most of them. A toy factory looks like a machine for turning plastic into profit. Cheap materials in. Expensive product out. The gap in the middle looks like money. In reality, that gap gets claimed by several different hands before the factory ever sees a dollar of it, and by the time everyone else has taken their share, what the manufacturer keeps can be thin. According to a European Commission commissioned industry study, long-term profit margins for the top 100 toy firms in Europe were estimated at roughly 6%. That figure comes from an older, EU-specific dataset covering large firms, not a universal number for every toy company everywhere. And it is not profit on a single toy, it is an estimate for the entire business, after everything. It won't match every operator, but it illustrates how much can disappear between an attractive shelf price and what a company finally keeps. So the real question is not how a factory makes money. It is where all that money disappears to, and why a business that looks this profitable on paper can quietly be one of the more fragile operations in manufacturing. Start with the toy itself, because the toy is the least interesting part of this story. Resin, pigment, a few grams of steel for the mold, some electronics if it talks or lights up, a battery, packaging, a label. Call it $1, maybe $2, for materials and direct labor combined. If manufacturing cost were the whole story, toy factories would be printing money. They are not. The gap between that dollar and the $20 shelf price is not profit sitting there waiting to be collected. It is a queue of claimants, and the factory is usually near the back of the line. Here is the queue, roughly in the order the money gets pulled out. The retailer takes its margin first because it controls the shelf, and shelf space is one of the scarcest resources in this entire business. Then come the safety and compliance costs. In the United States, many toy categories, including those involving small parts, magnets, batteries, sound-producing mechanisms, and projectiles, require third-party testing by a laboratory accepted by the Consumer Product Safety Commission before the product can be certified for sale. Some smaller manufacturers qualify for limited testing relief, but a children's product certificate backed by supporting evidence is still required regardless. Every category carries its own protocol, and every protocol costs money before a single unit is sold. Then freight and duties, which move with fuel prices and tariff policy and are almost entirely outside the factory's control. Then the mold itself, custom-built steel tooling that might cost tens of thousands of dollars and needs to be amortized across however many units actually sell, which is a number nobody knows in advance. Then, if the toy carries a license, a fee to whoever owns the character. Then marketing, then returns, which in this industry are not rare. Then markdowns, when a toy that looked promising in June is sitting unsold in October. And only after all of that does whatever remains reach the people who own the factory. This is why gross margin is such a dangerous number in this business. A toy can carry a beautiful gross margin, 60%, 70% even, and still lose money by the time it reaches the bottom of the income statement. Mattel is worth pausing on here, with one distinction kept clear. Mattel is not a factory. It is a global brand owner that designs, licenses, and markets toys largely through outside manufacturing partners, so its numbers describe branded company economics, not the economics of the plant physically molding the plastic. With that in mind, Mattel reported a gross margin of 48.7% in 2025. Healthy-looking number, but Mattel also paid out $264.6 million in royalty expenses that year, money owed to whoever owns the characters printed on the box. It also booked $38 million in inventory obsolescence expense, the accounting term for toys that were built, shipped, and then never sold, because a trend moved on before the inventory did. $38 million of toys built with real capital sitting in a warehouse worth less than what it cost to make them. That number alone tells you more about this industry than the gross margin does. Now think about the shape of demand itself, because this is where the business gets genuinely dangerous for anyone running the factory floor. Roughly half of annual toy sales in this industry happen in the final 3 months of the year. 1/4, 50% of the year's revenue, which means a toy factory spends 9 months building inventory for a 3-month window it cannot fully predict, financing materials, labor, and overhead the entire time, without knowing whether the toy it bet on will still be wanted when the window opens. Picture the position this puts an operator in. By September, the warehouse is full. The bank loan that financed all that resin and assembly labor is outstanding. The factory has already spent the cash. What it has instead is inventory, an asset that is only valuable if a child wants it in December. If the toy sells through, the factory is fine. If a competitor's product catches the trend instead, or a video game absorbs the attention that used to go to physical toys, the factory is left holding a warehouse of plastic that is worth a fraction of what it cost to build, and the debt used to build it does not go away just because the toy did not sell. This is the part almost nobody outside the industry understands. A good Christmas season and a bad Christmas season do not look that different in October. The inventory looks the same sitting on the shelf. The difference only becomes visible in January when either the cash has come back in or it has not, and by then it is too late to change anything about the bet that was already made. Two companies learned this the hard way, in almost opposite directions, and both stories explain the same underlying mechanism. The first is Mega Brands, a Canadian toy manufacturer that spent much of the 2000s competing directly with Lego in the construction toy category. In 2005, Mega Brands acquired a company called Rose Art, expanding its portfolio and its ambitions at the same time. On paper, this looked like sensible growth, a broader product line, more shelf presence, more scale to spread fixed costs across. By 2010, the company's assets and liabilities were estimated somewhere between $100 million and $500 million, a real, substantial manufacturer. Then several things went wrong at once. Product recalls hit demand and reputation simultaneously. Raw material costs moved against the company. The debt taken on to fund the acquisition did not shrink just because sales did. Mega Brands tried to restructure, aiming to cut roughly $290 million of debt and around $30 million of annual interest expense. It was not enough. In February of 2010, Mega Brands sought creditor protection in Canada and equivalent protection in the United States. Notice what actually killed the company. It was not that the toys were badly made, it was that debt does not care whether your Christmas was good or bad. Interest payments, lease obligations, and principal repayments are fixed claims. When a recall or a soft season hits revenue, a factory can slow down production, but it cannot slow down its debt service. An operating problem, a bad quarter, a recall, a shift in taste becomes a liquidity crisis the moment fixed financial obligations are large enough that they cannot flex with the business. The second case is Lego, and it is more instructive because Lego nearly failed for the opposite reason. Not too little ambition, but too much of it, spread too thin. Through the early 2000s, Lego expanded well beyond its core plastic brick into clothing, video games, theme parks, and dozens of new product lines. It looked like smart diversification, the kind of move that turns a toy company into a lifestyle brand. By 2004, the results told a different story. Revenue from toys fell from 7.196 billion Danish kroner in 2003 to 6.704 billion the following year. The company was carrying 4.731 billion kroner in liabilities tied to continuing operations, on top of a large base of fixed assets that were no longer earning their keep. The core problem was not that Lego's ideas were bad. It was that the company had built more manufacturing capacity, more product complexity, and more organizational overhead than the actual demand could support. Every new category meant new molds, new supply chains, new testing requirements, new forecasts that could be wrong in a new way. Complexity does not show up as a single expense line. It shows up everywhere, quietly, in every part of the operation that now has to coordinate more moving pieces than it can efficiently manage. By 2004, Lego reported an operating loss of 1.122 billion kroner and a net loss of 1.931 billion kroner. The company impaired 723 million kroner of fixed assets it no longer needed and booked 502 million kroner in restructuring charges. That impairment is the accounting proof of the deeper problem. Lego had built factory capacity for a future that did not arrive, and idle capacity does not sit quietly. It keeps generating depreciation, rent, and maintenance costs whether or not it produces a single brick. What makes Lego's story worth telling twice is what happened next, because the company did something rarer than either of the failures above. It figured out its own economics and acted on what it found. The turnaround was not built around a new hit product. It was built around subtraction. Lego returned to its core construction system, cut its excess capacity, closed a plant in Lettich, reduced its workforce by roughly 1,000 people, and simplified a product line that had become too complicated to run efficiently. The 2004 annual report described the goal plainly: restoring competitiveness by reducing the number of things the organization had to coordinate. Fewer molds, fewer components, fewer product variants, fewer forecasts that could go wrong. The results showed up almost immediately. Production and operating costs fell by 1.523 billion kroner, and the company moved from a loss before special items of 1.061 billion kroner in 2003 to a profit of 103 million kroner in 2004. That is not a story about a better toy. It is a story about a company that finally matched its capacity, its complexity, and its cost base to the demand it actually had instead of the demand it hoped for. This is the counterintuitive finding sitting underneath the entire industry. More capacity looks like more opportunity. In practice, capacity is only valuable when demand is there to fill it. A factory running at low utilization is not neutral. It is actively destroying value every day it sits there, because rent, depreciation, and debt service do not pause just because the production line has. There is one more layer to this, and it might be the most important one because it explains why owning the factory is not the same as owning the profit. Licensed products, toys built around a character someone else created, made up 32% of toy sales across the major markets Circana tracks, its G12 group of countries, in the first half of 2024. That's a large tracked market figure. Not a literal measurement of every toy sold on Earth, but it's still the clearest available signal of how much of this industry runs on someone else's intellectual property. Nearly a third of everything sold in this industry is built on intellectual property the manufacturer does not own. Mattel alone paid $264.6 million in royalties in 2025, money that flowed out before the factory's own profit was calculated. Think about what that actually means. The factory does the hard part. It solves the tooling problem, the compliance problem, the labor problem, the logistics problem, the working capital problem. And after solving all of it, a meaningful share of what remains still belongs to whoever owns the character on the box, because that character is the reason a parent picked this toy off the shelf instead of the unbranded one sitting next to it. The uncomfortable truth is that manufacturing skill in this industry is closer to table stakes than to a competitive advantage. Almost anyone with enough capital can build a factory that produces a technically good toy. What is scarce is not the ability to mold plastic. What is scarce is a character child already love, a retail relationship that guarantees shelf space, or a customer base that trusts the brand enough to buy without being sold. Those are the positions with real pricing power, and none of them require owning a single injection molding machine. So, look again at the queue of claimants. The retailer controls the shelf, and shelf space is finite. The licensor controls a character that cannot be replicated. The platform, increasingly, controls the customer's attention. The factory typically controls very little of that. It controls execution, which is necessary, valuable, and often one of the least well-compensated positions in the entire chain. That is not a moral failure of the system. It is simply where scarcity sits. The factory's product, physical manufacturing capability, is comparatively abundant. There are many facilities in the world that can mold plastic to spec. There are very few properties that a 7-year-old will specifically ask for by name. Which brings the story back to that 80-cent dinosaur and its $20 price tag. The $19.20 in between was never sitting there waiting for the factory to claim it. It was already spoken for by the retailer that gave the toy its shelf space, by the laboratory that certified it safe, by the freight company that moved it across an ocean, by the character owner whose name sold the toy in the first place, and by the bank that financed 9 months of production before a single unit was sold. The factory's real economic equation was never simply price minus cost. It was demand quality multiplied by how fully the plant was utilized, multiplied by whatever contribution survived after every one of those claims, minus the complexity of running it, minus whatever went unsold, minus the fixed obligations that do not care how the season went. A toy factory can be technically excellent and still economically fragile, because excellence in manufacturing was never the scarce input. The scarce input was always demand that someone else controlled. The 80-cent dinosaur was never the business. The $20 price tag was never the profit. The real product being sold in every toy factory, in every country, in every Christmas season was the right to stand at the front of a very long line of people who all believe, correctly, that they deserve to be paid first.